It's pup. The nurse put me on a nice dose of the blue pill, and she told me it would be a great idea for me to tell you guys why I bought these ETFs this week at these proportions. So this is why I did that. So just to be clear, I want to give a big warning. This video is for parody and entertainment purposes only, and I'm not a certified financial advisor. So first, I want to give you guys a big update on my health. As many of you guys are aware, I broke my neck during a dirt bike accident in late September. A clearly zany guy named Rob Deerdeck had a show called Ridiculousness where they featured entertaining stunts. This was, the show had a massive warning that was constantly repeated throughout the program. And literally, it was unavoidable, saying not to replicate the stunts or perform any on my own, but I chose to ignore it. So this was that warning. The activities in this show are dangerous and could lead to serious injury. Do not attempt any stunt or activity in the show. MTV and the producers insist that no one submit any videos of themselves or others performing any dangerous activities. It then says we will not open or view them. So I attempted, a quadruple backflip after ignoring this loud, constantly repeated, and blatant warning that I was not supposed to be repeating what I saw on the digital media. But I chose to avoid it, and I broke my neck. Right? So this guy was clearly being zany. He was clearly just trying to entertain people with a documentary of, the foolish antics of people in the extreme sports world. But I ignored his warning. And I actually called their show and I was like, hey, Rob, what the heck, man? I broke my neck. I tried to do a quadruple backflip. I wanted to get on Ridiculousness. You know what Rob said? He said, first off, that warning is mostly for children. Right? So if you ever have a YouTube channel where you do kind of extreme stuff, like you try to make tons of money at one time or something like that, right? Make sure it's not for children. I was like, oh, okay, Rob, that's obvious, right? And then he was like, secondly, if you had landed that quadruple backflip, gotten real famous, blown up, had tons of podcasts, tons of sponsorships, tons of all types of stuff, would you have given me any money? And I was like, no, obviously not. I wouldn't have given you a damn penny. Anyway, the ETFs and the proportions I bought on Tuesday were this. I bought 15.73% RDTE, 9.41% XDTE, 13.74% NVDY, 8.71% DIPS, 8.66% BABO, 9.63% GDXY, and 9.89% MSTY, which was paired with 9.05% CONY and 11.1% FIAT, rounded out with 4% SCHH. So the largest position is new fund risk. My initial position with RDTE. This is the Round Hill Small Cap Zero DTE Covered Call Strategy ETF. It's the first ETF to utilize zero DTE, 0 days to expiry options on a small cap index. RDTE seeks to provide overnight exposure to the small cap index and generate income each morning by selling out of the money 0 DTE calls on the small cap index. RDTE is actively managed, it has weekly distributions, income potential through a synthetic covered call strategy. I have a whole video about XDTE, which I also bought, very similar to this, and it also harnesses volatility, very similar. We'll get into XDTE. I have a whole video about that, so go watch that. New fund risk, why I bought 15.73% RDTE. The fund uses deep in the money call options on the Russell 2000 to get Delta 1, or the synthetic stock exposure equivalent to owning 100 shares, and then sells 0 DTE out of the money contracts to generate income and achieve capital appreciation paid weekly. Pros, XDTE, which is a very similar ETF just on a different index, beats SPY by a factor of 36% to 29%. Total annualized returns when blindly averaged into. Based on my most recent calculations, which I'll show soon, if RDTE beats IWM by a similar fashion, it allows for more upside to the equal-X target of IWM 300 versus SPY already being close to the equal-X target of 600. That's for wave 3. IWM has more value inflation exposure than SPY and higher implied volatility. We should look at IWM for a sec. I think I have IWM already marked up. I own IWMY, and I've been buying it. Yes, we see IWM moving along. One, two, three, four, five. Wave 1, ABC wave 2, wave 1, wave 2, another wave 1, another wave 2, I believe wave 3 of wave 3 in progress. That's where that same or equivalent equal X target of wave 1, wave 2, past the 50% retracement. Now looking for a length of wave 1, place of the wave 2 low. And I believe we're about to confirm above 228, 229, 5 waves minimum from this low. And we can get to 300 from there. Let's get back to the presentation. So RDTE, I own IWMY. The fund uses call options to get this Delta 1 exposure. So what's the bad part? Let's get to more of the good. IWM, as part of the Russell, is going to have a lot more value stocks, more oil, more financials, and more industrials, as well as more materials stocks. As far as oil, industrials, and SPY also has a lot of industrials as well. So we have more oil and we have more materials, most likely, in IWM. Based on that, there's more inflation exposure, would be one aspect. And also, SPY has really been leading this exact same corollary analysis where we're seeing it close to 600. You can see my pinned tweet. So this is potentially going to be more upside than SPY. Thank you, nurse. So, what are some of the bad parts? New fund risk, no back testing. Obviously, it can be, the total returns can be back tested manually. I believe they're positive that the ETF has gone up and it's paid large dividends. So that must be positive total returns doing that. But we have very little data anyway. It's not even in the ETF total return calculator. 0.95% expense ratio, pretty high. So that's important to understand. So if RDTE isn't beating IWM the way that XDTE is beating SPY, this 0.95 expense ratio based on the tax situation, may not be worth it, according to, you know, do not take tax advice from anyone you hear on YouTube or Twitter unless they are a CPA. I am very far from a CPA. 9.41% XDTE. Dividends increased in August. VIX spike for XDTE. We're going to show that. But let's just see right now. XDTE blindly averaged into from 3.7 to 10.4 versus SPY 3.7 to 10.4. We see a 36% total annualized return plus a massive, I believe, upper 30s, low 40% dividend yield paid weekly for XDTE versus almost no dividend, very little for SPY, and it's a lower return, almost basically 29% to 36%. So RDTE can do this versus IWM. Big positive showing right here during that big August VIX spike. Even though XDTE went down, the dividend went up. Why? Because this ETF is selling 0 DTE out of the money call options. That means that they are adjusting very quickly to changes in the VIX, especially the short-term front month futures for the VIX. So that's very interesting. This ETF potentially pairs extremely well with SVOL that actively manages a fund that mostly holds bonds, but it also shorts the front month VIX futures. That's something I'm going to look into, but what I wanted to show, potentially a big positive for RDTE, when the VIX spikes, so do these dividends, even though obviously the underlying price went down for XDTE during that August VIX spike. Another position, 13.74% NVDY and 8.71% DIPX was added to a previous trade from August 2023. My cost basis initially established for NVDY from July to August of 2023 is 23.84. NVDY is currently 24.87. Today is October 11th, post ex dividend. Then I began adding NVDY and DIPS to a 3 to 2 ratio after the initial position had paid for itself 1 year later to lock in gains to allow the original position to get further into the black and indirectly hedge XDTE and YMAG. YMAG, huge distribution this week, similar to what CRSH and TSLP does. YMAG and XDTE and IWY, all the 0 DTE ETFs from Defiance now paying weekly. Huge development. This allows me to keep buying the Yield Max Week 2 dividend with RDTE, XDTE, QDTE, YMAG, IWMY, WDTE. That's the new name for SPY's 0 DTE ETF. For puts, JEPI, they changed JEPY to RDTE. That's the Defiance ETF, not the JP Morgan ETF. QQY, same name still, and BABO. So I like BABO as the week 2 for me personally. I'll talk about why in a sec. Cons of NVDY and dips doesn't back test well. Blindly averaging into this while dips has been just wow. Blindly averaging into NVDY since inception, 100% total annualized return. I took part of that, which I've been talking about up here, right? And showing all these dividends I collected. Since DIPS has existed, we do not see positive total annualized returns blending dips with NVDY. For CONY, Coinbase, and Fiat, the one that shorts Coinbase, we see slightly positive returns. That makes it, in my opinion, a good hedge. For TSLP, that's Curves ETF, not Yield Maxes, the positive Tesla ETF, paired with CRSH, the short Yield Max Tesla ETF, we see quite positive total annualized returns on a Delta neutral ETF. I have a whole video about that. I certainly own that as well. So anyway, more pros to blending NVDY. So I have a big winning position on NVDY and dips. No, not dips, but I have a big NVDY winning position, and I'm actually higher right now than my cost basis, which has collected enough dividends to pay for itself. So the whole point of all that is to say, I have a pre-existing position, and that's why I'm able to take this. Also, I'm using a ratio 2 short NVIDIA ETFs to 3 long NVIDIA ETFs. That's price, not share count. 3, I'm also blending this with YMAG and XDTE, which is currently unhedged. So this indirectly hedges that, since NVIDIA normally outperforms. Anyway, untouched chart of NVIDIA. This is just the most recent untouched chart of NVIDIA. Good Lord. We see it looks like it's on its way to 155. I've talked about how taking the length of this rally, placing it this low, can take it to the 170s. I'm going to keep collecting dividends from then. That's why I'm still net positive. And so very interesting things are going to open up for me. Obviously, look at my... if you're unfamiliar with my long-term history with NVIDIA, welcome to the channel. You're joining at a very interesting time. Very smart time, but a very interesting time. I hope this is like your first week on FinTwit. Anyway, why I bought 8.66% BABO, important to know. I have a winning position. I think it's a winning position on KLIP. I say that because blindly averaging into KLIP since its inception gives a 9.31% total annualized return. I began taking positions in CLIP around here. We're higher than that on KWeb. We've gotten a lot of dividends from CLIP, but it is not actively managed, or it is actively managed, but it's not doing the synthetic. Look at MSTY. MSTY went all the way up, basically all the way up with MicroStrategy today. KLIP never goes up with KWeb, based on what I've seen. But MSTY tracks it very cleanly. Okay, so I believe there's a lot of options activity that is allowing NVDY and MSTY, and soon CONY, to participate in rallies that other yield max ETFs cannot. I currently can't prove that, but yield max is moving up. They're readjusting. They're rebalancing. That 0.99% expense ratio will allow yield max to keep readjusting their ETFs for their best active managers. So it's important to know they're not all created equal. Their best active managers are going to be able to keep adjusting their ETFs to the upside and to the downside. They're not all created equal. The implied volatility of the fund, very important. Obviously, the underlying is very important, how it performs, but also the active manager themselves, how experienced they are at climbing the ladder when the stock's going up, and climbing the ladder down, or scaling the ladder down when the stock is going down. These are very intricate things to do. We see today MSTY up 10%. That's pretty insane, because this ETF most likely is going to pay out, I want to say, well over 100% dividend yield, and it is climbing with MicroStrategy step for step. There's very few dividend payers at all, even in the 8 to 12% range, that are even capable of going up 10% in a day, unless there's an extreme anomaly. Anyway, BABO, I already own CLIP. I've shown, this is my untouched chart of KWeb, my untouched chart of Alibaba, my untouched chart of Alibaba is not too shabby either. So this is BABA. Recently, I own BABA, and so what I can do is I can keep adding BABO to BABA, and I can keep if we start seeing CLIP perform better, I can start adding back to CLIP again. But we're seeing, this is my untouched chart of Alibaba. The premiums got very high. We'll see what goes on with that stock soon. But if CLIP keeps having a positive total return, and BABO, which so far it does, but it's very little data. This is 2 dividends a month from China, completely diversified. Some people believe Chinese ADRs are technically not owned by the foreign investor. That's quite a lot to get into. Why I bought 9.63% GDXY. It's got a 41% yield. Total annualized return 11.57% when blindly averaged into. Pretty good. I already own OUNZ. Had a winning position on NGD calls, New Gold Corp. I have coma nightmares about silver. We're seeing Newmont. That's the chart of Newmont. We're seeing Angico Eagle also. Angico Eagle is very quickly climbing this ladder. Oh God, I was gonna say, am I still in a coma? It's in the 70s. It's almost in the 80s. This is my untouched chart of Angico Eagle, right? So I've got untouched charts of NVDY, Angico Eagle. I can probably list a lot more than that. But just the difference in those two, MicroStrategy now at an all-time high. Just a list of the ones that I own, and then another one. Why do I have coma nightmares about silver? Well, wow, on the exact same day as that October 2nd eclipse, all these people are saying my bank account's showing zero. What's going on? Bank account zero with Bank of America. We keep having these glitches. We had AT&T and Verizon have an outage after a solar storm. We had another Verizon outage after a solar storm. We've had bank runs at JP Morgan in the past year. Bank, zeros. We had a Bank of America glitch in September. Sorry, a JP Morgan glitch in September, a Bank of America glitch most recently in October. And in the stock market, we see these glitches all the time. Berkshire Hathaway going to zero. AT&T and IBM having ridiculously large moves, and they were just glitches with a host of other stocks. Anyway, nurse, stay away. Sorry. Forget I said that. Why I bought 9.05% CONY, 11.1% FIAT, and 9.86% MSTY from a previous BITO, BT, and CONY coin long. It's been, just knowing that I had those positions and still have these two positions. I've taken a nice bit of profit on BITO, partly because of the great dividends. I took a lump sum position, 66% CONY and 33% coin base that has already paid for itself with a 240% return, capital gains on coin and dividends, fiat and coin together. Fiat and coin yield 99 to 107% respectively. Successfully adding these three together with MSTY, Fiat, CONY, and MSTY. I already own BITO, potentially giving some hedging to the downside, blindly averaging into MSTY, even though a good bit of it since February has been a correction, 108%, big power of options premium. Let's get into this pair trade, essentially understanding I have a winning position with Coinbase already from September. I took a big position in Coinbase and CONY. CONY paid for itself, and Coinbase got a 240% return. I sold Coinbase, but I've been holding CONY. Now what I'm doing is that basically when Coinbase is blindly averaged into so far, or Fiat is blindly averaged into the ETF that shorts Coinbase, it makes about $2,231 from $3,000. $2,179 from $30,000. CONY blended together. Since 7/11, the exact same date, loses less than $2,000. So one ETF blindly averaged into makes about $100 to $200 more than $2,000. The other ETF loses less than $2,000. So I already have a big winning position on this from a year before, and I'm blending CONY, Fiat, and MSTY just recently together. I've been buying MSTY for a bit. My average cost basis, I've gotten a pretty nice position there, is 26. 25 to 26. Now we're well above that. And if we look at since this exact same date, all three of them, one makes more than 2 grand, one loses less than 2 grand, and then the other one blows it out of the water. It makes over 7.8 grand from 30K. Looking at the paired trade analysis, we see for the past 3 months, we have a 0.34% correlation coefficient because MicroStrategy is strongly outperforming Coinbase. So I'm going delta neutral. I already had a big winner here from a long time ago. It's already paid for itself. Now I'm going delta neutral, and it's essentially hedging MSTY based on this correlation and also based on this outperformance. So it's getting a little technical there. The last thing I did is I've been buying SCHH. This is the ETF from Charles Schwab that owns real estate. It's got the lowest expense ratio, I believe, of the real estate ETFs, competing with VNQ. I already owned RQI. That's the closed-end fund. It uses leverage. It has a higher dividend yield, but it also has a higher expense ratio, mostly because it's using leverage, but also because it's actively managed. So the devil's advocate for a lot of these funds in this video is they've got high expense ratios. I'm really, really interested in making sure that the premiums that I get from these funds are keeping and maintaining their value. Right now, the biggest thing that I want to make sure I don't get outrun by are real estate prices. That's not the same case. I know people who the biggest thing not to get outrun by is debt. I know people who the biggest thing not to get outrun by is oil. I know people who the biggest thing not to get outrun by is equities. So, for me, it's real estate. So I invest in SCHH to get that most important upside exposure. For me, lower the overall expense ratio for these funds as well.